All right, so we're going to talk some more about taxes. The key thing on taxes is, on the income side, unless you're running a small business or something like that, you don't have a lot of latitude. It is what it is. You're going to, in terms of your earned income, it's going to come in a certain amount, and, not that you're trying to hide money from the government, but you don't have very many options in terms of tax deferring, tax shelters, other than, 401ks and things like we talked about. If you've got a private business, then there's all sorts of different things you can be doing in terms of depreciation, characterizing income, and all that other stuff. It really goes beyond the scope of this. But on the actual filing of taxes and stuff like that, you can all do something in terms of the way you structure your spending and the things you spend it on, and the more you basically do things that are beneficial in the tax code. In my mind, you can't really completely talk about taxes, especially in an election year, without sort of touching on the whole notion of taxes and the rates and the ethical nature of it. I actually had a student who basically got very upset, and I was saying basically what it was, and my statement that kind of set her off was that in the lower, I mentioned the progressive tax code, right? And in the lower stratus, you don't have to pay as much in the way of taxes. And oh, by the way, if you have a number of dependents, so if you're a single parent with say 4 kids, something like that, you're going to take in more money than you pay out. That's the nature of the way the tax code works, and that's fine. But the only problem is sometimes it does kind of push people down who would otherwise rise up and be a bit more aggressive, but they can't afford to do it because the way the tax structure is set, they'll lose their health care, and they can't afford to do this, or they'll lose this other deduction. So the tax code is far from perfect, and there's some real problems. But now, especially with the healthcare situation, that is such a high dollar item that a lot of people will go through great hoops to include working less, doing less to still qualify. Anyway, there's another thing too. A guy Laffer. Now this is controversial. You can look it up online, and you can see what you want. Some people say, it's nothing, but it's kind of common sense. And we've kind of seen this like in France, for example. They'll come up with, we're going to have a 90% tax rate on high wealth individuals. Guess what? That never gets done. The people, they move, they do whatever. I mean, they're high wealth individuals. They have options, so they go someplace else. So, when they did that in France, for example, Iran, whatever. The UK got a few more residents and other things. The big picture was it ends up being more political. So what Laffer had said was basically there's sort of a sweet spot where to get the maximum amount of taxes for the government, there's a certain rate they can charge. But if they start to charge anything above that, what happens is the rate goes up, but the economy goes down. So think about it as like a pie, right? And if you want to take 1/4 of the pie, that's pretty reasonable. If you say, I'm going to take 1/3 of that pie and I'm going to have more pie, guess what? You're probably not. Because people who are, perhaps going to work a second job, perhaps going to earn income in your country, perhaps going to do other stuff, they're going to go someplace else. They're not going to, you're going to discourage, the aggressive behavior. Now, if you lower that tax rate from 25 down to 20, you're thinking, we're going to lose money, but in Laffer's, concept, the pie actually gets bigger. So, granted, you're only getting 20%, you used to be getting 25, but the pie is so much bigger that it generates more income for the government. And anyway, the models have pretty much shown that to be true. Now, there's a sweet spot. If you say we're only going to tax 5%, evidently but obviously the government's going to get quite a bit less. But there's a number in there, and some of these political gimmicks of incredibly high tax rates are so they don't get collected. There's also we'll talk about it in other aspects, but there's a whole bunch of companies that have corporations that have gone overseas because of the tax system here. So when you hear of Apple over in Europe, a lot of those companies will go to Ireland, they become Irish corporations because the tax rates are low. They'll do things like inversions, like Burger King. Burger King is actually a Canadian company now, and so I guess it's last year. They bought Tim Hortons, which is a small coffee shop, and very, very important in Canada. I mean, I don't mean it. What's that? Yeah.
What's it called?
BHP, Bed Happy. I went to Canada, Canada, or in Afghanistan, and there's all Canadians there, and they actually put a Tim Hortons down. But anyway, Burger King, big company. Tim Hortons, quite a bit smaller. They bought Tim Hortons, and they did an inversion. They moved their corporate headquarters for Burger King and everything up to Canada, and now they're paying less in taxes. So you got to be careful with tax rates because bad things can happen, especially on the corporate side. And it's all the major, the Googles, the Apple, all those guys have got a lot of stuff overseas that might come back to the U.S. if the rates come back. So we'll see what happens. Okay, so we talked about the 5 filing categories we're about to. Single, kind of a no-brainer, legally separate, same category. Married filing jointly, so there's 2 of you, you're each making $50,000. You lump that together, you file jointly. But when you go to the tax table, you go to the married filing jointly tax tables, you'll probably end up paying less tax. You could still file them individually, married filing separately, but the tax spike's going to be a little higher. How do you figure out all this stuff? Go to TurboTax and hit married filing single. Go to the whatever software you're using, run it both ways. But you'll see over time, then unless the laws change drastically, it's probably better to be joint. And then head of household, just like it says, unmarried individual who maintains a household for a child with family. So that's my situation. I've got a daughter under my whatever, but she's away at college, so still qualified, but that good deal's going to go away, and then I'm going to be single, and I will literally get clobbered. As a single guy, if you're making pretty decent money, you'll get hammered. But that's just nature, you know what I mean? And then qualified widower, so, bad things are happening in your life. Somebody, your spouse just passed away. The IRS is not, like a vulture. No, they're just delayed 2 years out. Then they'll come after you. So you could stay in your old category for 2 years, get things squared away, and then they're going to get you single. Unless you... Anyway, summary of tax calculation. So I think we kind of went through the basics. I mean, the basics is not that involved, but the thing is so complex and there's so much to it that it really is something that you need to. The worst thing to do is take somebody a box of stuff and have them do your taxes completely, and you have no clue what's going on. That's going to cost you money in the long run. If you know what's going on and you get a second opinion from somebody completely separate from it, that's a good idea. Or get their advice. But unless you want to pour on the stupid questions, you need to know a little bit about it. You'll figure it out over time. All this stuff, people, like I say, you'll be financially literate by the time you hit retirement age, but it's going to be like a could have, wish you. You'll know enough that you won't have the time on your side. So other taxes, payments, withholding, determining if you're able to refund and sending it back. So anyway, you just this is fairly seamless if you use the software, but if you're using the paper forms, you will literally flip from one page to the other, look at charts, look at tables, and come up with your amounts. But all that, when you look at your W-2, your income type statement thing you get at the end of the year, 32, 34, all those kind of documents, there will be withholdings, estimated withholdings. But those are just estimates. The real deal is done when you file your taxes. Now, you can't file your taxes, really. I mean, I never get all the documents until sometime probably in February. So usually I file them in March. And if you owe a bunch of money, people will wait till April 15th. But that's kind of silly. If they owe you money back, if you're getting a refund, file. Get that money back now. If you owe them money, there's a strategy to perhaps wait a little bit. But it's a fine line. If you're late, then it's a problem. Other things, So, yeah, they talk about going straight to the IRS, but I do it in just the exact opposite order. If you start out with the IRS thing, it's going to probably tumble you a little bit because it's written very, most of them. And again, there's a document that we were talking about last week that comes out once a year that's sort of a summary. But the real tax publication stuff usually is fairly tough. And these phone things, they typically don't pick up the phone. So Ernst & Young, big accounting firm, put out a tax guide. There's other people out there too, but I would stay up just to, I'd use the internet for just general search to get you pointed in the right direction, but obviously when you're called in an audit and to say, oh, I saw something on the internet, that's not going to be good. And then tax preparation software, it will guide you through there. And a lot of times if you dig down those menus why am I not eligible for this, it'll refer you to a publication. Yeah, and it's pretty helpful. But for a lot of folks, having a paper copy is interesting as well. So electronic filing, more and more the norm. And again, it doesn't typically cost, even with the typically paid service things. They'll let you set up an account because they know that you're only going to be doing the free version for a couple of years, and then once you're making any money at all, you're probably going to be itemizing deductions and probably going to be buying their more elaborate products. And it's all good. Refunds generally 2 to 3 weeks. It's usually not a problem. Again, instant refunds, no such thing. That's just a loan based upon your estimated refund. You sign over your refund to that company, and they loan you back the money. It's kind of simple. Telefile. I mean, this is now that the internet is much. The telephone services are largely not what they were. Tax preparation services. Like I said, a real accountant, or at least somebody who's that's his specialty. But H&R Block is flooded with a bunch of people who are just kind of hired part-time and do it during the season. Probably not what you're looking for. The enrolled agents is what, in fact, we were talking after class a little bit about how the enrolled agents, they kind of cleaned up the act, and the threshold now for preparers is a little bit more than it used to be. Now, accountants and attorneys now are probably talking overkill, unless you've got guys kind of money. Lawyers, attorneys, whatever, $250 an hour is kind of a going rate. So if you got whatever amount of money you'd have to have some pretty intricate taxes before I want to get it done. And I wouldn't want some general purpose attorney. You'd have to be a tax attorney. So that's probably not good. Professional tax preparer makes a mistake, you're still responsible for paying the correct amount. But they will sign on the form with you. And there are certain things where they have like an audit defense where they, it's like an insurance plan where they'll cover it. There's different options, but anyway, things are going to go very, very bad for you if it comes out that you're intentionally trying to cheat. If you made a mistake, that's one. If you are audited, so that 1%. So if they say 1% are audited, that means for general folks, it's like 1 in 1,000 are going to be audited. Those other 9 people out of that, whatever, the bulk of that 1% are going to be it's time is money. I mean, the auditors only have so much time, and they're going to go after the big, juicy targets that look like, something's funny here. Because you get a set of documents, and then you fill out the tax forms with your documents as well. And if those numbers don't jive, you clearly are cheating a little bit. A lot of times now, and again, I sound like a show for the companies, but you can download the documents where they kind of auto-load into the software, which is nice and prevents some of those errors. But if you've got screwy things, foreign income, foreign property, look like you're doing something, or just have deductions that are way out of whack for your category, could be a problem. So, I did this, I guess it was 2 years ago. I got a thing from the IRS. Oh, you made a mistake, you owe $60. I'm just like, there you go. No harm, no foul. I don't want to talk to you. You don't talk to me. No questions, and just move on. But if it's something major, and now there's even these services that claim So you can get your tax bills down. But these are for people who don't pay their taxes year after year and problems like that. Taxes are kind of a tool for, let's say somebody's like a big drug dealer or somebody's doing some sort of crime. It's kind of hard sometimes to catch them in the act, but they'll use the tax code to handle people. Because what they'll do, let's say I'm unemployed and you've got all these fancy cars around, the IRS will literally come to you and say, all this stuff, how did you pay for it? And obviously, you're not. What's that? Yeah, exactly. Then they'll go to those friends. Okay, where did you get that? Anyway, there's somebody at the end is going to be without a tax document to show where this income came from, and that's where they got you. So all the gangsters back in the 30s and stuff, that's how they really come to you. They don't actually catch them robbing the bank. They catch them with the money and say, where did this come from? And so, you're going. So the penalties for taxes are pretty high because they're really used for other things. So anyway, the taxes in the IRS, anyway, it's interesting stuff. So this whole business of avoidance and evasion. So evasion is jail. Avoidance is not even cheating. Avoidance is encouraged. Avoidance is what you should be doing. Adopting kids, owning a house, all that stuff is good. And that's why they want you to do it. So they'll scoop you to do it. So let's say, now again, you got to do this before the end of the year. Minimize the taxes, accelerate deductions. You can't wait till April and say, I wish I would have accelerated my deductions. It's too late. But you could say if you owned a business or you had a home office, something like that, and you've got a computer that you're saying you're using, in your job as a college professor. As long as the university applied for you, you could change the deduction thing to where it's deducted quicker or whatever. You've got a big piece of equipment. My small business, I have an airplane, right? Do I really need an airplane? Kind of sort of, because I've got some customers out in the bush. It's kind of extravagant for the level of my business, but I'm not really concerned with generating income in the business. So anyway, this business is going to leave me guaranteed because it's got a lot of options. I got some really cool stuff spread around the yard that our business is. And it's legitimate. It's a small business like that. A little bit more flexibility. Delay receipt of income. Yep. So if you can, if you're getting a bonus from work or you're getting a bonus somehow and you have any adjustments pushing into next year, delayed deductions. If you expect to have a higher tax rate next year, you need the deduction and receipt of income. So, there's certain unique situations. You get terminated from a company. I know a whole bunch of guys who got pushed out of the Navy. And, Navy's a huge organization, but they were actually able to say, look, we're all junior officers, they're all flyers, and they said we're, whatever, 30s or whatever, early 30s, maybe late 20s, and said, we're going to go back to grad school, we're not going to be working next year, can you delay, because they're giving them a severance package, they said, can you delay till after the first of the year, the $40,000, get out of here bonus that you're giving us. And so the Navy decided, yeah, that's no big deal. We're going to give it to you on the 31st, we'll give it to you on the 1st, boom, it rolls into the next tax year, and then they get this big $40,000 lump sum, but they're just a college student, so that's their only income for the year. And $40,000 for income taxes is not a big hit at all. $40,000 in addition to their say $70,000 they're making as a lieutenant, chief, lieutenant probably. Anyway, so they'd be looking at $110,000. They'd be paying a pretty high tax rate. So anyway, if you can move stuff around like that, and that's why I say, if you're in government work, you don't have that kind of latitude. If you're a businessman, you can move stuff around. So homeowners, I've hit that where you definitely want to be a homeowner. Deduct that mortgage and property insurance. How you're going to do financing? Home loan, again, it's lumped in against, it's far against your home. Credit cards are not tax deductible. Job-related expenses, you can be creative here. You got to be honest, but if I wouldn't have this thing other than working at that place, then maybe so. And you'd have to dig into the rules. You know, if you're driving from the valley and commuting, and you know you're burning through cars every 3 years. You know, I've never been in that situation. I've never been outside the allowable limits, but I would certainly research it if that's the case. Tax exempt investments, you know, just make sure that they are comparable, and that's where that calculation I was talking about with the 0.72. So, just a quick thing on the tax exempt investment. Let's say, you know, something is paying. I'm trying to come up with numbers that I can do easily. Well, let's just say 10%. Okay, so let's say you get an investment that pays 10%. 10%, you know, as a taxable yield. That's a great investment right now. You're probably not going to get that, but anyway, 10% as a taxable yield. Or you can get a tax-free for, let's say, 6%. Which is the better investment? I don't know. So what you do on that is, let's say you're a 28% tax bracket. You need to know what your marginal tax bracket is. So let's say it's 28%. So what you would do in this case is you would get 1 minus 0.28, right? That's going to give you 0.72. So after taxes, your 10% investment is actually going to be giving you 7.2%, right? And we said the other investment, the tax-free one, was 6%. I'm better off taking the taxable investment, paying the taxes, and earning 7.2% by CNO. So it's not that hard, but it just tumbles people. And this is good to know in the real world, but it's also very good to know for test as well. And there's other numbers like that you should kind of have that concept in your mind. Rule of 72, you're familiar with that a little bit? Rule of 72, it's pretty accurate, more than accurate enough. If you know, and it's just a thing for kind of wagging, spitballing investments. If you get a number and you divide it into 72, that's the number of years it will take to double, right? So if somebody says, you know, I'm going to pay you 72%, well, your money's going to double every year. If somebody says, I'm going to pay you, you know, 10% on the investment, 10 and 72, 7.2 years, your money will double. If somebody says, like, you know, we're looking at savings accounts and stuff, I'm going to pay you 1%, that's just not going to work. You're not going to live that long, and inflation is going to strip it all away, so don't bother. You know what I mean? But if you're looking at investments, that's knowing Rule 72 is helpful. Not necessarily a tax thing, but it just kind of came up. Tax exempt investments, so we talked about that. Some of these treasury bonds, I will show you the numbers on those. They're embarrassingly low. They're just not. If you know, big picture, all things aside, if you don't have the stomach for the stock market or mutual funds, real estate. But some of these, putting it in a savings account, and you're not going to be building well. We're looking at potentially negative interest rates in the future. So you just can't get there from here. Other things, long-term capital gains, so self-employment. The thing about a house, see, when you sell something, let's say you buy, you know, stock for $30 a share, it goes up to $50 a share. You've got capital gains of $20. And guess what? At the end of the year, boom, you're paying taxes on that $20. But with a house, and again, this is another great thing, you have to live in it 3 of the past 5 years. But if you do that, and there are certain limits, but anyway, up to a certain amount is, and we're talking like $300,000 to $500,000 is, I'll get you the exact numbers next week, is tax-free. I mean, there's very few investments where those capital gains are tax-free. Now, so if it's like a rental property, I had a buddy when I was in Spain, and he bought like a starter home in literally East LA, kind of a rough neighborhood, you know, and he's living in Madrid now, kind of living a good life. But he needed the cash, and him and his wife are going to suck it up and go live in this, in this home in LA. They've been a rental for a long, long time, and they will check on you, you know, if you challenge them. But anyway, you live in that home, so they qualify, so they could get the capital gains when they sold that home. But I'll get you the exact numbers next week, and especially when we get into the real estate part. Children's investments, certainly you can shift income to the children. They're saying less than $1,500. But you can also, when you're investing for children, there's all kinds of special vehicles, educational IRAs, things like that, 529s, covenants, different plans that we'll talk more about as we go. Retirement planning. So I think we hit on that. The other thing about this is Social Security. I mean, again, it's kind of a tax at this point. You know, you're supposed to get it back, but you know, this notion of it being in a lockbox, that's long since been raided. It's not anyway, and it will be. It's already talking about means testing it, where let's say you've got, you know, $1 million in the bank, there may be no Social Security coming back to you because they, you know, need it for other folks. So pension plans are kind of going the way. Most things now are, you know, kind of on your own. You've got IRAs, 401ks. You have to do it yourself, and then opportunity. So I mean, if you're good at finances and you set things up, you can have control and you can do very well. And you can put all sorts of strange investments. I mean, you can really push the limits in terms of like having a 401k with real estate in it rather than stocks. You know, special rules and stuff, but you can do that. You can have one with gold in it. I would not do that. But anyway, you can have other investments other than just stock market or 401ks, but that's up to you. So if you're good, but if you don't know what you're doing, yeah, it can be very, very bad. It sounds like everything's political tonight, but This American Life, I mean, it's like a NPR show, which is kind of interesting because you wouldn't expect them to have this concept, but they talked in here about it's a show back there from a couple years back, but they talked about what's going on with disability insurance versus welfare and all that. I'll probably save that to another class, but the gist of it is there's kind of bounty hunters out there that will, attorneys that will go to a state, and the states will basically pay them $1,500 for every person that they can convert from long-term welfare, which is a state problem, to disability, which is a federal problem. And so it's a shifting thing. So all the numbers are getting screwed up on that. That's a bit more involved. So these are the actual tax brackets. So this, you know, for due in April 15, 2016. So my numbers, you know, if you're making, well, it depends what category you're in, but let's say you're probably the most common, I guess, is married, filing jointly. So up to, you know, 18,000 something, you are only having to pay 10% on taxes, and you probably qualify for all sorts of other programs. So in all actuality, you are getting money back. And then from 18 to 75,000, nearly 15%. And then so these numbers, those numbers I was rolling off were mainly the single category. But anyway, you can see this is where this notion of a marginal tax rate comes up. If you want to figure out an average tax rate, you have to go back and look at the specifics. But anyway, you're going to see that it's going to be quite a bit lower. And then a top tax rate of 39.6. But the bad news about this is the federal tax only. In Alaska, it's the same thing. But if you're in, well, right now it is. If you live in someplace like California, New York, New Jersey, you know, you're approaching 63% for the top tax rates when you combine the state and the federal. So, you know, starts to become a disincentive, and that's the problem. It keeps people from, well, they might move, they might exploit it some other way. And this was just a thing of capital gains. Warren Buffett, for example, says that my secretary is taxed at a higher rate than I am. Well, that's because his secretary is earning income, straight income. She's paid a salary. And he's making his money by buying and selling stocks. So he's paying capital gains on investments. She's paying taxes on earned income. And the rates are completely different. So again, what they're trying to do, the reason why the rates are lower at capital gains is because they want people to get out there and invest. They want people to be buying stocks. I mean, they set these rates, and it's to spur, investment. So, and the notion is too that where'd you get this money to invest? You probably had to earn it at some point, and you got taxed on it that time, and now you invest it and you get taxed again. I mean, so it doesn't apply to somebody like Warren Buffett who made all his money from investments, but for most individual investors, you turn your earned income into investment money, and then, anyway. I can't, I'm not going to debate the fairness or the whatever of it. That's just the way it is. I'm trying to look at the clock here. Because what I wanted to do was have enough time to talk again a little bit about the project. Has anybody? I mean, I'm not anticipating folks to be necessarily started on it, but there we go. But there's nothing wrong with it. I mean, if you are going, then even better. I've had, a lot of students kind of, especially if they're confused on what's involved in the project, come to me and send me like rough drafts and things like that. And nothing wrong with that. So the dates on here, I'm not super hard and fast. What I do want to try and do is be conflicted from finals time. And again, you have latitude, but if you're a traditional student and you don't have a huge, not huge, but a normal income at this point because you're a student, it might be more useful to pick a time and place about 5 years out. And you can do this anywhere from using kind of your own numbers, but please don't tell me if they're your own numbers because I don't even know that. But or you can come up with sort of a fictitious person and give them numbers, because a lot of this is just going to be estimates anyway. So you would go out there and go to the different salary kind of websites that are out there on the web and figure out pretty much what somebody in your given field makes, so you have an estimate. And that might be instructive to you too. I mean, even as a student, you're going, wow, I really wanted to be a nurse, for example, but I didn't realize I didn't get paid that much. Nurse is probably not a good example. A vet might be an excellent example. Those guys go to a lot of school, and the compensation is not what you think it is compared to, like, say, a doctor who does kind of the same thing and can be very well compensated. Anyway, 4 to 5 page paper. Don't sweat that though, because it's kind of a checklist type thing. You'll come up with that sort of bulk. You won't be struggling to find the content. And then the other thing is too that just for some of the things you've seen in here, whether it be, I've never really seen people incorporate things from Mint, but there are all sorts of things on bankrate.com that have different calculators and stuff for maybe prospective retirements, for household type things, for different online calculations. And those things will generate, graphs that you can, screenshot on PowerPoint or Word or whatever, and incorporate them into your presentation. So, and then, you got to have a plan. You don't know what's going to really go on, but, you've got a dream or a plan, and how are you going to get there from here? So, do you plan on being married? Maybe you already are. Do you already have kids, or do you plan on having kids? So, those things are all going to factor in what's going to go on. We'll talk a great deal about insurance, but insurance is kind of backwards from what you think it is. The people who need the largest amount of insurance could be people in your category right now. Whereas people, as they get older and wealthier, they need less and less insurance. In fact, they need no insurance at the end. Your goal is to be self-insured at the end. You can actually do that with vehicles, but you don't want to. You have to post a bond and all the rest of that stuff. But like the state of Alaska, for example, is self-insured. You don't have a fee you're paying to somebody. But the gist is that insurance is for the people that will be left behind. So again, I think I mentioned before about this Gerber baby life insurance. I mean, it truly is taking out insurance on the child, which is backwards. The parents are the ones who need the insurance. So anyway, figure out based upon your life stages. You haven't paid off your house. Your spouse is not able to be fully employed right now because home with the kids, maybe. Anyway, they're certainly going to, even if they are working, your income's going to be out of the picture. Kids haven't gone to college, the rest of that. So you're going to need much more insurance, but it's going to be very cheap if you are using like a term type plan. So you'll look at that. You also probably want to look at Social Security. I mean, they're fairly honest. Well, they are honest. They'll tell you kind of what your income would be through Social Security, and you'll see that that's just not going to be good enough. So look at that. Do you think you'll have a pension? Is that part of the realm? Even in the military, they're talking about cutting it back and other things. Anything that appears like a great deal for a pension is starting to go away. So 20-year pensions out of the military are starting to go away as well. So 401k, all that other stuff. We'll talk more and more about that kind of stuff, but you'll figure out, okay, I'm going to save for retirement. What's the smartest way? What's the way to keep the maximum amount of my wealth and generate more? So that's good. What else? Yep. Time value of money. You'll get in those charts. You'll look at what's available. So it's pretty good stuff. I could show you some. Well, I'll shy away from showing the examples because some of them may actually have real numbers in it. I don't want to stumble upon that. Let me show you though, as long as we've got the internet working fairly well tonight. Bankrate.com. We'll just take a quick look because there's, they've got a lot of banner ads and other stuff, but they're not a company themselves that sells stuff. Bank rate calculator, fixed mortgage rates. So did I get to the wrong site? I think that was like a I guess it was just their site, just like a weird storefront. So calculators and tools. So you can obviously do, the mortgage stuff. That's kind of the bread and butter. That's where people are really going to be jumping in there. But down in here, investments, savings calculators, retirement calculators, how much do I need to retire? So if you're really, struggling, going, I don't know where to start, open up something like this and start filling in numbers, and you'll have a chart, you'll have numbers, you'll essentially end up with a plan. So annual income required in today's dollars, 30 grand. If you were smart, you paid off your house, your kids are through college, 30 grand is probably not bad. I mean, I would probably want more. I'd want to be doing travel and paying for other stuff, but you could get by. Number of years until retirement, so hopefully that number's bigger than 15. This is for somebody who's this is probably accurate, where most Americans don't think about retirement until far too late. But let's say realistically for you guys, this ought to be like 45, right? At least 40. We'll go with 40. Number of years required after retirement, that's 25. Sounds like a lot, but that could be the case. If you're retired at 65, 70, 90, I don't know what the average life expectancy is going to be, but that may not be completely unrealistic. And you do want to sort of not go, oh, damn, I lived an extra year and now I'm completely broke. So anyway, I would err on the safe side. Annual inflation, I'm going to put that at, even with today's, I think I'd go with 2.5. It's traditionally around 3, but we'll call it 2.5. Average yield balance, they had 7.5 in there, and we'll stick with that. We'll go with 7.5. Anyway, and then you calculate it, and it's going to give you basically, the number. So, required income 30. You will need $1.2 million basically to get there from here. So, and that's what they're doing is they're showing this $1.2 million. So this is, don't worry, this is not money you have to put in. This is money that you had $1.2 million when you were 65, and you start withdrawing it, and maybe you get 90%. But you were able to draw that amount of money. So that is just the. That's kind of a strange calculation. I was looking for one, and they do have them on here, where the amount of money you would now use that number. Go, okay, I need $1.2 million, and then you go back and start doing the calculation in terms of what I need to get that $1.2 million. And remember, I said, kind of from the get-go, I said, do you really need about $1 million? And I was just ballparking it because I'm saying I was going with a higher number. I'm saying 10%, and I wanted more money in retirement, but I'm saying I'm going to suck out, just live off the interest of my $1 million, making 10% interest. Tough to do, especially as a retiree when the market's going up and down. But if you could do that, you wouldn't be touching that principal, and you could live to however long you wanted to live, and the kids could get that $1 million. You would be leaving in retirement. They have is anybody familiar with a reverse mortgage? It's not a sign of desperation, but it's I don't know, kind of screw the kids kind of plan. Where what happens? But people get in a situation where they own a house, but they have no income, and they're retirement age, and they're the house will be sold after they pass away, but it's not going to do them any good, obviously. So there are companies out there that will set you up with a reverse mortgage, and what they do is they give you monthly payments, and they're basically buying the house from you, and then when you pass away, then they own the house. So there is no, giving it on to your heirs. Maybe your kids are all set, squared away, and maybe they're, encouraging this. Maybe they're the ones, not being forced, but giving you money for you to survive and have a decent lifestyle. If you get into a reverse mortgage, perhaps you can, be self-sustaining and do that. So there's lots of different things going on out there. It's hard to say, but any of those type of arrangements, I would certainly want to know something about the company. Which brings up a good point. Does anybody know anything about Allied Bank? It used to be GMAC, and they had such a horrible customer service reputation. They just no brand, that whole their brand value was nothing. To the point where they just changed the name and pretended they're a whole new bank now, a very customer friendly. Maybe that coincided with a an attitude change, but that is the old GMAC, where General Motors Acceptance Corporation, the financial arm of General Motors. So, any questions on the project? For me, I think it's something fairly useful, to to kind of get you, you may not think about this stuff again for a number of years. And to delve into it and come up with a plan now, and at least, realize that opportunity cost, that I'm going to wait to save for retirement until I really have some money I can put into it. The problem with that is you really need a lot of money to put into it if you wait, because the time value of money. If you just had a little bit right now, literally, you give me $50 a month now, or you can give me $1,000 a month in a certain number of years, and that number of years is not that many. It's just far easier, and also it builds good saving habits. So, anyway, any questions on this stuff? We'll probably wrap it up there for tonight. Any questions? Anybody have any trouble with the homework? Not too bad. It's fairly straightforward. You'll see some of those concepts I discussed come back, in terms of like comparing tax exempt versus taxable. And again, make sure you understand that, because you'll see that on the test. The tests are fairly comprehensive, but it's nothing bad. And we'll do a big test review before we actually have the test. That'll be out there on video, so even if you come to class, you can still, watch it again at your leisure. But if you, I'm not saying I'm not tolerant, but people who don't do well in the test, it's probably because they, didn't really pay a lot of time on to the review, because the review is pretty thorough, and it will focus. It's much more efficient than just reading the whole book again. If you listen to the review and then skim the book, you'll be much better prepared than trying to take it all in and concentrate on something that's not going to be on the test. We got time for that, though. All right, then. I will see you next week.